You ever wonder why some people seem to weather every financial storm like they saw it coming from miles away, while others get completely blindsided by the same exact crisis? It's not insider information. It's not luck. And it's definitely not about having more money to begin with. It's about following a rule so simple, so old, so consistently proven that you'd think everyone would know it by now. But they don't. Most people have never even heard of it. Yet in Jewish communities, this rule gets passed down like a family heirloom, taught at kitchen tables, whispered during Shabbat dinners, and practiced so religiously that it becomes second nature. I'm talking about an investment principle that survived empires rising and falling, economic depressions, hyperinflation, wars, and every market crash you can imagine. And the wild part? It's not complicated. You don't need a finance degree to understand it. You don't need a trust fund to apply it. You just need to know it exists and be willing to follow it even when everyone around you is doing the complete opposite. Growing up, I watched my family make investment decisions that seemed weird to outsiders. Conservative, almost paranoid. While neighbors were bragging about putting everything into the hottest stock or the newest opportunity, my relatives were doing something that looked boring by comparison. But decades later, when those hot stocks crashed and those exciting opportunities evaporated, my family was still standing, still secure, still building. And I finally understood they weren't being boring, they were being smart. They were following the rule. Before we get into what this rule actually is, I'm genuinely curious. Where are you watching this from right now? Drop your city in the comments, because I love seeing how far these conversations travel, and knowing that people from completely different parts of the world are all learning the same timeless principles together. Alright, let's break down the investment rule that changes everything. Here's the rule, and I want you to really hear this because it sounds almost too simple to matter. Never put all your eggs in one basket. I know, you've heard that before. Everyone has. But here's the difference. Most people have heard it. Jewish investors actually live it. They don't just nod along and then ignore it. They build their entire investment strategy around it like it's a religious commandment. Because historically, for Jewish communities, it basically was. Let me paint you a picture. Imagine living in a time and place where your property could be seized overnight. Where the government could suddenly decide you're not allowed to own land anymore. Where being successful in one industry could make you a target. Where everything you built could disappear because someone in power decided they didn't like your last name. That was reality for Jewish communities across Europe for centuries. So what do you do when stability is an illusion? When nothing is guaranteed? When the rug could get pulled out from under you at any moment? You spread everything out. You diversify so completely that no single disaster can destroy you. My great-grandfather owned a small textile shop in Poland before the war. But he didn't just own the shop. He also had money in 3 different banks, in 2 different countries. He owned a small piece of a cousin's bakery. He had gold coins hidden in places only he knew about. He lent money to trusted people with clear repayment terms. To an outsider, it might have looked paranoid. But when everything fell apart, when borders closed and businesses were seized and banks collapsed, he survived because not everything was in one place. That mentality, that deep-rooted belief that concentration equals vulnerability, it didn't die with that generation. It evolved. It adapted. And today, Jewish investors still practice it. But now it's not about fleeing countries. It's about financial resilience in an unpredictable world. They don't just buy stocks. They split between stocks, bonds, real estate, cash, maybe commodities, maybe even alternative investments. They don't fall in love with one sector or one company. They spread it out so that when one thing tanks, and something always eventually tanks, they're protected by everything else that's still standing. Now let me tell you about something that makes this rule even more powerful. It's not just about spreading your money across different investments. It's about spreading it across different types of risk. Most people think diversification means owning 10 different stocks. But if all 10 stocks are in the same industry, you're not actually diversified. You're just concentrated with extra steps. Jewish investors understand layered diversification. They think in categories. Some money goes into things that grow slowly but steadily, like index funds or bonds. Some goes into real estate, which provides income and appreciates over time. Some stays in cash for emergencies and opportunities. Some might go into a small business or a startup, higher risk but higher potential reward. And some, even today, goes into physical assets like gold, just in case everything else goes sideways. I know a guy, Benjamin, who runs a family investment fund. When I asked him how he decides where to put money, he pulled out this old notebook his grandfather gave him. Inside was a simple pie chart, hand-drawn, dividing wealth into 6 categories: safe growth, income generation, emergency reserves, speculative opportunities, physical assets, and community investments. His grandfather created that chart in the 1950s. Benjamin still uses the same framework today, just with modern investments filling each slice. That's the difference. It's not reactive diversification, where you panic and spread things out after a crash. It's proactive, disciplined, intentional diversification built into the foundation of how you invest from day one. And because it's a rule, not a suggestion, it doesn't get abandoned when things are going well. You don't get greedy and throw everything into whatever's hot right now. You stick to the plan. You respect the rule. Because the rule has survived longer than any market trend ever will. Here's where most people mess up, and I mean really mess up. They think diversification is a one-time event. They set it up once, maybe when they first start investing or after reading an article, and then they forget about it. Markets shift, investments grow at different rates. Suddenly, without realizing it, their portfolio that was once balanced is now 70% concentrated in one area. And they don't even notice until it's too late. Jewish investors don't make that mistake because they've been taught that diversification requires maintenance. It's not set it and forget it. It's review, rebalance, and adjust. Regularly. My Aunt Ruth, who's probably the most financially disciplined person I know, reviews her investments every quarter. Not obsessively, not emotionally, just methodically. She looks at the percentages. If one area has grown too much and now represents a bigger slice than intended, she rebalances. She sells some of the overperforming asset and buys more of the underperforming ones to bring everything back to the target allocation. Sounds counterintuitive, right? Selling winners and buying losers? But that's exactly how you maintain protection, because today's winner could be tomorrow's disaster, and you don't want to be overexposed when that happens. I watched her do this in 2007. Tech stocks were soaring. Her tech allocation had grown from 15% to almost 30% of her portfolio just from appreciation. Everyone around her was celebrating, riding the wave, buying more tech. She rebalanced. Sold some tech, bought bonds and real estate. People thought she was crazy. Then 2008 hit. Tech crashed. But her portfolio barely flinched because she'd already protected herself by following the rule, even when it felt wrong, even when it seemed like she was leaving money on the table. That discipline, that willingness to rebalance when things are good, not just when they're bad, that's what separates people who build lasting wealth from people who ride roller coasters and wonder why they keep ending up back where they started. Let's talk about something uncomfortable. Emotion. Because here's the truth. The biggest threat to diversification isn't market crashes or bad investments. It's your own feelings. Fear makes you sell everything and hide in cash. Greed makes you chase the hottest trend and abandon your plan. Ego makes you think you've figured out the secret and don't need protection anymore. Jewish investors have a cultural advantage here, and it's not genetic, it's experiential. Generations of uncertainty create a healthy respect for risk, a skepticism toward anything that sounds too good to be true, a bone-deep understanding that markets are cyclical, that what goes up will come down, and that overconfidence has destroyed more wealth than any crash ever could. I remember my father telling me about a distant relative who got rich in the late 90s with .com stocks. Guy was a genius apparently, made millions. Everyone wanted his advice. He started believing his own hype, thought he had the magic touch. So he doubled down, put everything into tech stocks, borrowed money to buy more. You know how this story ends. 2000 hit. He lost it all. Not just the gains, everything. Had to start over in his 50s. My father told me that story not to scare me, but to teach me. He forgot the rule, my dad said. He thought he was special. Nobody's special. The rule exists because we're all human, and humans make mistakes. That humility, that acknowledgement of your own limitations, it's baked into the Jewish investment approach. You follow the rule not because you're scared, but because you're smart enough to know you can't predict the future. You can't time the market perfectly. You can't avoid every mistake, but you can protect yourself by never putting all your eggs in one basket, no matter how sturdy that basket looks right now. All right, last thing, and this might surprise you. The rule isn't just about protecting what you have, it's about positioning yourself for opportunities. See, when you're properly diversified, when no single investment can wipe you out, you operate from a position of calm. You're not panicking when markets drop. You're not scrambling to sell. You're watching, waiting. And when everyone else is scared and prices are low, you've got the stability and liquidity to act. I know an investor, Daniel, who follows the rule religiously. During the 2008 crash, while people were losing homes and retirement accounts, he was calm. Not happy, not celebrating other people's pain, just calm. Because his diversification meant he was hurt, but not destroyed. And because he had cash reserves, one of his diversification categories, he was able to buy real estate at bargain prices when everyone else was panic selling. Those properties are worth triple now. He didn't get that opportunity because he was smarter than everyone else. He got it because he followed the rule, stayed diversified, kept reserves, and was positioned to act when opportunity appeared. That's the hidden power of this principle. It's not just defense, it's offense. When you're protected, you can be patient. When you're patient, you can be strategic. And when you're strategic, you win over the long term, every single time. So what's the investment rule Jews follow that most people don't know? Never put all your eggs in one basket. But it's not just knowing the rule, it's living it. Actually diversifying across different asset classes, different types of risk, different time horizons. Actually rebalancing regularly, even when it feels wrong. Actually maintaining discipline when emotions are screaming at you to abandon the plan. Actually staying humble enough to admit you can't predict the future, so you protect yourself instead. This rule survived centuries because it works. Not sometimes, not in certain conditions, always. It works in bull markets and bear markets. It works when you're young and when you're old. It works with small amounts and large amounts. It works because it's built on the fundamental truth that uncertainty is the only certainty. And the best way to handle uncertainty is to spread your risk so broadly that no single event can destroy you. Think about your current investments right now, wherever your money is sitting. And ask yourself honestly, if one sector crashed tomorrow, would you be okay? Drop your answer in the comments. Just write, "I'm diversified," or "I need to fix this," because acknowledging where you are is the first step to getting where you need to be. Hit that like button, because when you do, you're helping YouTube understand that real financial wisdom, the kind that's been tested across generations, deserves to reach people who are tired of chasing trends and ready to build something that lasts. Subscribe right now because what's coming next goes even deeper into the strategies, the psychology, and the cultural patterns that separate those who build wealth from those who just talk about it. I won't spoil what's next, but I'll say this much. The principles that protect wealth in chaos, the mindset shifts that turn average earners into millionaires, and the secrets hiding in plain sight that most people walk right past. That's exactly where we're going, and you'll want to be here when we get there.